Hi, everyone, and thank you for joining today's webinar on feed grains and their impact on the protein markets. My name is Kate Hubbard. I'm the Director of Marketing at ArrowStream, and I'll be your host for today's presentation. For those of you who aren't familiar with ArrowStream, we are a supply chain technology company for the food service industry, and we're headquartered in Chicago. So here you can see that our network consists of over 200 restaurant chain operators, over 1,000 distribution centers, and over 6,000 suppliers, in which our solutions help our clients streamline their supply chain, collaborate with trading partners, and improve their food quality. So here on the screen, you can see the breakdown of how our solutions span those key supply chain partners to create a single end-to-end platform. And the most recent solution within our platform that we launched is called Strategic Sourcing, and it's for restaurant chain operators. And I want to take a few minutes to talk more in depth about this tool before we hop into today's presentation. So we built this tool with best practices in mind so that our operator users are able to run a standardized and repeatable sourcing process, which includes sourcing new products, improving service and food quality, as well as lowering their food costs. And since launching in May, we already have several operator customers using the tool. And here you can see some of the initial successes that they're seeing. So users have seen food costs decrease by 18%. They've seen the time it takes to run sourcing events decrease by 25%. And lastly, when running an event with multiple suppliers, 67% of our users validated that their incumbent supplier was the right fit for their organization and awarded them the bid. And this last metric is important for us to call out because our sourcing tool can not only be used to discover new partners, but also to validate and strengthen existing partnerships. And so I want to share what the strategic sourcing workflow looks like, how it enables our users to fully optimize their procurement operation, as well as, what makes those metrics possible. So you can see in this workflow diagram that it really begins with assessing spend as well as the market. So like we're going to be doing here today. And this assessment allows users to identify consolidation opportunities as well as compare expiring contract pricing so that they can then begin to plan their strategy. And on the next slide here, you can see, we really encourage a sourcing calendar, which is a great way to plan as it helps align resources and contract timing, as well as really allows our users to be more proactive. So this is definitely a best practice that we encourage our users to leverage. And so once planned, users can access our database of over 6,000 suppliers who all specialize in food service. And so we call this database Supplier Discovery. And within Supplier Discovery, users can search by product, category, distributor, and other food service attributes to locate new suppliers as well as new products. So whether using a new supplier or an existing supplier, our users can easily set up RFP events that automatically invite suppliers to participate, as well as remind them to bid. And after bids are in, our users can analyze and compare multiple scenarios, such as comparing the cost of keeping an incumbent supplier to the lowest cost bid. And some of the last steps in the workflow bring that sourcing process full circle by automatically updating contract pricing information, identifying misbilled items, and reducing contract administrative burdens. So the last thing I'll say on strategic sourcing is that it's really a tool that can be used by operators who run several sourcing events annually, and also for those who only run a few annually. And it's not just for center of the plate items. So our users have seen great savings when running RFPs for non-food products as well. So think about cups, straws, things of that nature. So switching gears, I'll transition into our presentation for today. Before I introduce our speakers, I also want to mention a new weekly email that we've launched. It's an overview of key commodity markets and other vital news for the food service industry. So it goes out each Friday, and it includes ArrowStream's commodity price trends, trends to watch, ArrowStream's restaurant commodity index, as well as information on upcoming webinars and other types of resources. If you don't already receive this email, you can subscribe on our website. It's a little pop-up and you can just type in your email and then you will be added to our distribution list. And so on the next slide here, I want to quickly mention some of our upcoming webinars. So on August 27th, we'll be sharing a general outlook on food costs in order to help plan budgets for 2020. So keep an eye out for those emails. We will be sending emails to register in the next few weeks. So for today, we're going to take a look back at the last few months, how the extreme weather conditions have affected corn and soybeans, and what that means for the protein markets, such as beef, pork, and poultry. Leading us through the discussion today will be David Maloney, Dr. Isaac Olvera, and Jerry Dalton. And if you have questions for them during the presentation, please go ahead and type it in the questions box in the panel on your screen, and we will have time at the end to address them. So I'll go ahead and introduce our presenters. First, we have David Maloney, who is EVP of Analytics at ArrowStream. Before being acquired by ArrowStream, David was the president and founder of the American Restaurant Association. He's been advising food service clients about commodity markets and contracting since 1996, and his expertise has been utilized by thousands of companies and media venues. We also have Dr. Isaac Olvera with us today. Isaac is a commodities and data analyst at ArrowStream. He's a blockchain traceability expert and holds a master's in forecasting and simulation modeling, as well as a PhD in animal science production economics. Isaac formerly worked with Informa Economics within the various meat proteins with a heavy emphasis on beef. And we also have Jerry Dalton here today, who is Director of Commodities at ArrowStream. Jerry has over 20 years of physical and financial trading experience, along with forward contracting, hedging, and purchasing capabilities. Prior to ArrowStream, he worked with multiple commodity companies, including Cargill. So thank you again for everyone for being here today, and I will hand it over to David to begin the presentation.
Thanks, Kate, and thanks everyone for being here. So you may have heard that it's been a little wet and cool in the Midwest, at least it was during the spring. And this is problematic for the grain crops, which is problematic for the restaurant industry because grains, particularly corn and soybeans, are your principal food ingredients for the major food cost exposures for the restaurant industry, which are proteins and dairy. And to illustrate this on this first slide, this is January through June precipitation totals for the Corn Belt and for the soybean belt. And you can see here, and this data goes back to 1895, that it has been, we've had the most rain during the first 6 months of this year that we've ever had for corn and soybean belt. And what this did is it delayed planting at levels that we haven't seen in decades. So, and it wasn't just the rain. Well, what this rain helped cause, quite honestly, is some intense soil moisture conditions. This is the June Palmer Drought Severity Index. Basically, what you need to know is the higher the bar, the wetter the soils, right? And you can see here that June for both corn and soybeans were the wettest we've seen, again, since 1895. So it's not only the rain delaying planting or delaying farmers getting into the field, but it's also the wet soil conditions which has delayed farmers getting into the field. So we do get some numbers or some indication of field work days from the USDA every week in their weekly progress report. So we build a model here based on the major corn and soybean states. And this is the year-to-date through first week of July, and that's a little misleading because most of these states really can't get into their fields until March at the earliest. And so usually the year starts about March, okay? Sometime in March, late March for some of these states, like North Dakota, it's early April. But you can see here that the total average amount of days was 43.8, and this is weighted, by the way, by production. You know, at first glance, obviously this is the least amount of days that they've been able to get in the fields here in at least 2 decades. But you could see, well, we have some years that we were close. 2013, we were about 48. 2008, we were about 48. You know, we got corn and soybeans planted for sure, right? But it's really the question is just how much. As we think about that, one of the key reports that we got so far this growing season was at the end of June when the USDA did their second farmer survey of acreage numbers. As far as corn was concerned, they came in at 91.7 million. Now that was down from their initial survey in March of 92.8 million, but much more than the trade was anticipating. Soybeans came in at 80 million, okay, which was down about 4.5 million from the March number. And that was below what the trade was anticipating. But as we, for those of you who are commodity clients know, we wrote about this extensively. Probably the most important statistics to come out of that report was the percentage of crop that remained to be planted. So the USDA in June reported how much farmers expected to plant, had planted and expected to plant. But out of that 91.7 million acres, okay, of corn, 15.3 million of it had left to be planted. Okay, and to put that in perspective, as you can tell in this chart, we've never had, after the first full week of June, and that's when the surveying was occurring, okay, during the first 2 weeks of June, we've never had more than about 3.5 million acres of corn left to plant. Okay, and most of the times we're done at that point. In the case of soybeans, we had over 33 million acres still to plant of the 80 million. So almost, you know, on the way to half. Okay, and as you can tell, we've never had more than just over 20 million to plant as of the first week of June. So this has really raised questions on how many acres are going to get planted this year, right? And the expectation is that it's going to be south of the USDA's June numbers. And the USDA acknowledged that, and so much so that they're resurveying acres resurveying the farmers for acreage numbers later this month. And we'll get those results on August 12th. And really, I would offer that before August 12th, now we've built several models here to try to ascertain how many acres got planted, but I would offer that this year is unprecedented. You know, like I said, we have the most rain during the first 6 months of the year than we've had in over a century. We have the wettest soil moisture conditions in June than we've had for any June in over a century. So this year is unprecedented, and I would say that anybody who tells you they know what the acres are going to be in front of August 12th is wrong, right? Is wrong. Or has a very strong chance of being wrong. Let's put it that way. So if we look at this further, all right, though, and how we get to our acre numbers or our best estimates of what we think are going to get planted, let's think about how much farmers have planted after the first week of June. And again, in the case of corn, we've never planted more than 2 million acres after the first week of June. Well, this orange, nice University of Florida Gator orange and blue bar here of 2019 is what we have left to plant, right? And you can see that the likelihood of getting all that planted is not very good. Again, in the case of soybeans, we've never planted more than just under 20 million acres, okay? And again, we have 33 million acres to plant as of the first week of June. So, you know, our expectation is that we will have acres somewhere around 88.8 million for corn and about 77 million for soybeans. Now, a couple other things before I turn it over to Isaac, we start talking about weather and start talking about our supply expectations further. Crop conditions, as one would guess, aren't great this year. You know, roughly, I think it is 53% of the soybean crop and 57% of the corn crop were rated in either good to excellent condition by the USDA as of the second week of July. You can see those are the worst ratings we've seen since 2012, the second worst we've seen since 2005. Not a disaster crop. Those of you who remember 2012 was a major drought year, okay? I will tell you that we anticipate the conditions will improve a little bit in the coming weeks, assuming these weather forecasts hold. And so the weather will be key as we move forward, because it's not just when we think about how many acres are being planted or didn't get planted, we also have to remember that these acres are being planted late and this crop is behind, right? And so what we don't want at this point, at least as we understand it, we don't want is hot, dry weather to quickly reduce those soil moisture conditions. And so that's where I'll turn it over to Isaac, and he can kind of talk about the outlook for weather and our outlook for supplies.
All right, appreciate it. So moving forward, we updated these charts this morning. The one on the left here is the 3-month outlook for temperature. The one on the right is precipitation. The biggest thing that we note in the change from last month to this month is that there is a removal of lower than average temperatures throughout much of the Corn Belt and a shift back towards more normal temperatures. And on that fringe area to the outside, we see some elevating temperatures as well. On the precipitation side, we're going to see a little bit less precipitation moving forward. The big thing, and if you are a reader of the Maloney Report, we have talked about it. If you're not, you should be. But we have talked about it quite a bit, is just what weather is good weather moving forward. And the big thing is there's quite a divergence in the crop. The crops that got in the ground early are in a different stage reproductively than those that have been planted throughout June and into early July. We are still hearing folks that are planting into early July. So they have different stage needs or physiological needs at this point in time. But the big thing is we really just want to make sure that we stay away from the hot and dry and the overly wet. And moving forward, it does look like Mother Nature is kind of putting up the white flag right now, and that conditions aren't going to be as poor as they have been over the last couple of months. So moving into our stocks to use ratio, or at least our supply expectations. Here at ArrowStream, we have looked quite heavily at what our yield expectations are going to be, as well as our area planted. And we're sitting somewhere in the area about 88 to 89 million acres of corn planted at a 166 yield. Our yield is relatively in line with where USDA is looking. But that USDA planted acres number at 91.7 still looks a little bit high based on our expectations for how many acres there were to be planted and how many acres we believe got planted throughout June and into July. On the soybean side of things, we're looking for somewhere in the area of 77 million acres to be planted, with a yield somewhere about in line with USDA. So USDA's 80 million acres of soybeans, as well as 48.5%. But if you look at our stocks to use, which is oftentimes used in regression analysis to look at price, our expectation in stocks to use for both corn as well as soybeans are considerably lower than the USDA estimates. So if we look at it, we want to reiterate that we believe that there is some considerable risk to the downside in acres planted. How many acres got into the ground? This is just cumulative corn and soybean acres left to be planted for the first full week of June. I mean, so we've never had this many acres left to be planted throughout that time frame. The expectation then is, even if they did get those acres planted, what do their conditions look like moving forward, and how are they going to perform in aggregate? So again, we still continue to look at the risk maybe that these crops are smaller than initial expectations. As well as there were some rumors, some rumblings rolling around about prevent plant acres yesterday. The big thing is they're looking for somewhere in the area of 7 to 8 million acres of corn in prevent plant, or that was not able to be planted and will have insurance taken on it, as well as 2 to 3 million acres of soybeans. Those sit relatively in line with our general expectations. So, we're not really looking to make any major adjustments to our numbers just yet. Again, we're going to wait until that August report comes out, but we do feel relatively supported moving forward. So we'll look at our scatter, looking at stocks to use on price of corn. Right now, we're sitting somewhere in the area of 410, and it wouldn't be difficult to make an argument for 415, 420. Based on what we're seeing on the board right now in the futures market, we do believe that corn is fairly priced. USDA is looking for somewhere in the area of about a 370 on their latest, their July WASDE. We do believe that's a little bit to the low side there, as well as they've plugged in their 91.7 on acreage, so they do have a larger carryout or larger stocks to use ratio than we have plugged in. So on the soybean side of things, we don't have the soybean chart in here, but USDA is looking for something in the area of 840. A lot of the discussions that we have here intra-office, it really would not be difficult to add an extra 50 cents to $1 to that price point, just based on expectations for a smaller overall crop. One of the things that we do note is that exports are probably not going to be quite as large, and the overseas markets, with the biggest market obviously be most namely China. But if we do come in with a smaller soybean crop, risk again is to the upside on overall prices.
Well, one thing I want to kind of speak to a little bit, maybe Isaac, you and I can speak to it together, is so every month the USDA comes up with their crop production and supply demand numbers and comes up with that ending stocks number, which we compare to use, which has, as you can tell from this corn chart, gives you a good indication of price levels. But it's important to not get too confused with the numbers that came out from the USDA last week, because the USDA was essentially obliged to use the June acreage numbers of 91.7 and 80 million for 91.7 for corn and 80 million for soybeans. So I don't know many, if anybody, who expects that the USDA won't adjust those lower with the August 12th report. So for those of you that watch that report, I just want you to make sure you understand that it's almost a certainty that supplies are going to be tighter than what the USDA is giving us today.
Right, and just to cap that off, we wrote about it this morning in the Maloney report, just about how our expectation is that the market didn't react in a way that would have been expected to a larger corn acreage. We didn't see a market plummet. We didn't see a huge reaction to it, which tells us again that traders have likely baked in expectations for smaller acreage, and they didn't necessarily believe the USDA at the July WASDE. They're going to wait until that August report comes out to make their reassessments.
Yeah, one other thing before we transition to proteins that I would say is that we really haven't spoken to the demand part of corn and soybeans. And I think that, what we're seeing is that obviously we've got some trade issues with China. China's not taking our beans. They don't really need to take our beans all that much because of African swine fever. We're not exporting a lot of corn right now. So the $4 plus corn seems to be already rationing demand. World supplies on both are adequate to, you can make the argument, to a surplus. It would not surprise us, if all of a sudden, this crop is let's just say worst case scenario is 1 billion or 1.5 billion bushels. I'm speaking to corn, smaller than where we're at today. If we couldn't fairly easy ration a third to a half of that. So it is not like, although, you know, our acreage numbers, like I said, are our best guess. And we think futures are fairly priced right now. You know, even if we get a much tighter supply, it wouldn't surprise us if we ration some pretty good demand, which so we aren't anticipating like a panic run higher, you know, in corn prices. Maybe we get a panic to $5 temporarily or something, but I'd be very surprised if we move substantially higher than that.
All right, so transitioning into kind of where we're all here for is the protein supply expectation. The chart that we have up right now is per capita protein supply, but I want to speak first to per capita protein total protein production here in the United States. You know, moving forward, the expectation herein is that we're going to see considerably larger protein production throughout the back half of this year and on into next year. On the beef side of things, looking for somewhere in the area of 2% more production throughout Q3 and another 1 to 1.5% production throughout Q4. Our expectations are a little bit larger than USDA's. USDA is looking for lighter harvest levels of steers and heifers, but you know, tomorrow's cattle on feed report, my expectation somewhere in the area of placements down about 2 to 3%, but we're still going to have relatively large overall on feed inventories, which should continue to lend to larger beef production throughout the back half of this year and on into early next year. Hog production, or pork production, excuse me, you know, up 7.5% throughout Q3 and another 5.5% throughout Q4. You know, the big thing here is that we do expect to continue to see pork production escalating throughout the remainder of this year and on into next year. On the chicken side of things, 1 to 2% increase in production. We may see some modest pullbacks here over the next couple of months, but all in all, we do expect to continue to see broiler production continue to rise throughout the remainder of the year. The big thing to loop it back to overall feed prices, corn sitting in this 380 to 420 range is not really outside of the bounds of what we would expect to have been normal for the last 3 to 4, maybe 5 years. Obviously, we saw quite the shift away from the more expensive corn in that the drought time frame, but 420 corn is not really enough to push people away from wanting to run production higher. So I spent the last couple of minutes talking about how big production is going to be throughout this year and on into next year. But if we look at this chart, this is per capita protein supply. So the way this is calculated would be production plus imports of protein minus exports divided by US population. So we're expecting red meat and poultry production to be up about 3% in 2019 over 2020, or excuse me, 2% 2019 over 2018, and about 0.5 to 1% in 2020. But if we look at where we're at, up 1% in 19 and actually down modestly in 2020, the big piece here is a resurgence of exports moving forward. We continue to look for exports to drive some of this market moving forward, obviously with USMCA, Mexico and Canada coming back online, some issues that Australia is having with their beef cattle herd throughout parts of Asia, so Japan, South Korea as well. There's opportunities there for the U.S. to continue to move product into Asia, and again, China being another big one on the pork side of things. You know, the expectation that we're going to export larger quantities of product, again, paints the picture that if we do start to see a runaway in feed prices, the risk remains really to the upside on protein prices moving forward into 2020. If we continue to service the global marketplace, which we've shown history, which suggests that we will continue to seek out export partnerships, if feed prices run away, the expectation then is that there's going to be a considerable reduction of meat availability in the U.S. At this point in time, it does not look like that's going to be what occurs. At this point in time, We are expecting modest rises overall in protein prices moving forward. We'll speak to that obviously in next month's webinar more in depth. But at this point in time, we are looking for a continuation of a larger production and ample domestic supplies of protein moving forward. So with that, I'll turn it over to Jerry, talk a little about prices.
Thank you very much, Isaac. I wanted to, with the analysis, what's going on with the fundamentals and the markets, I wanted to speak to what we call technical analysis. History has a tendency to repeat itself. We don't just look at the fundamentals. We put it in balance with what prices have, what price action has done, kind of tell a story and put what markets are capable of doing from here, it's what we ultimately want to get a gauge on. So the key grains here, corn, soybean, you see my top chart here. This is a 52-week year over year. So from July 18th of 2018 to today. As you can see, corn is your biggest mover. We're up 23.5%, which tells you, hey, that, it kind of ties into the uncertainty of where the crops go from here. And corn's, as we know, a very valuable commodity. Soybean meal, the second down, another feed ingredient. You've got corn and soybean meal, your two major feed ingredients for the protein industry, up 6.9%. And HRW wheat, we're up 11.6%, 52 weeks from ago. To the right, you see some current market action as we started to have these weather challenges here in the United States, and that it's key to see that in June, nearby corn futures hit their highest level since in 5 years. The other one I want to stick with is soybean meal, the highest in 9 months. So again, in two major feed ingredients. Soybeans in June, highest in 4 months, and wheat highest in 4 months as well in June. Now the good news is that prices aren't higher than those highs right now. So which is telling you we've had some short-term weakness in the market. Doesn't mean we're out of the woods, but at least it's saying, hey, maybe the market's taking care of itself and supply and demand. But again, as David and Isaac stressed, that I'm not sure we're out of the woods there yet. So one other thing I wanted to mention with corn, before the call I got on, and interestingly enough, I said corn was the highest in 5 years, which was June of 2014. In July of 2015, the corn high was 443. July 16, the corn high was 439. And the May high before the June high was 438. So that was a key, what we call technical resistance level before we went to the higher of 464. And right now we're right at 430-ish, 428. So I'll be interested to see what prices do. If there is upside potential, this could be a bottom-ish area, again, so it's something to keep an eye on. The chart below, we have, as Maloney report readers know, on page 3, we do every quarter, we are showing you price trends and what's going on. For corn, we're at 429. That middle orange bar is your current price. The pivot levels below the price, and that kind of acts as a kind of where the meat of the market is traded and people did a lot of buying and selling, is a support level. And then 478 is an upside potential. Which could be resistance as well. So just wanted to point that out. Soybeans, I won't go through everyone, but you can see the prices here. Corn, again, is kind of the obvious one that's the firmest and still saying, hey, watch out. But in fact, some of these markets aren't, exceedingly above the pivot levels. Look at soybean meal, for example. You have the current price and the pivot level are right here at 307. So to watch that as well. And actually, you got your wheat market below the pivot level. So that tells you, hey, things are going in the right direction from supply, maybe. So yeah, with that, I just kind of want to show those numbers to you and some of the important technicals as well. I'll hand it back over to David.
So Jerry, it's fair to say, right, when the current market is above the pivot, we're in bull territory, and we're below the pivot, we're in bear territory. Is that fair?
It is fair.
Generally.
Yes.
Okay. Fair. So these kind of provide some guardrails to the market. And so in the case of corn, what we'll be looking for technically is if corn moves through 407, meaning moves lower through 407, that would be a bearish signal, right? But if we move higher, we look for 478 to provide resistance.
Right.
And if we move above 478, that would be an alarming sign.
That's correct.
Right? So that 478 level in the nearby markets, probably the 407 and 478 are probably two key levels to watch in nearby corn futures for those. Okay, great. Thank you, Jerry. So with that, if I summarize everything before we go into the Q&A, we have a long way to go with this crop, folks. All right, we're 3.5 weeks behind, perhaps, with this crop nationally. There are parts that are maybe as much as 6 weeks behind, and this is an unprecedented year. We don't know how many acres actually got planted. We're using our models to give our best guess, but we won't have a much better look into that until August 12th from the USDA. And then really, we don't fully understand how this delayed crop is going to impact performance or yields. So we've got a long way to go. Okay. Luckily, we will know a lot more on our next webinar, which we can share. But our expectation is we've got a demand problem for grains in the United States. World production is expanding. We use wheat as an example. We've had near century lows or near century lows in wheat production here in the United States in recent years, and wheat markets haven't even, they're still below 5-year averages. Why? Because the world is producing more wheat, and the world is going to produce more corn and soybeans in the coming year, especially if we do move higher and we sustain higher. I would expect in 2021 that our corn and soybean prices with normal crops will absolutely crash. So we do not anticipate that to be long-standing. And with that, Kate, we'll open it up for questions.
Okay, great. Thank you, guys. So anyone, if you do have questions, you can go ahead and type them in into the control panel. We do have a couple that came in, and the most recent one was, because there's still so much uncertainty, someone wants to know how can they keep up to date on the grain markets, with specifically concerning impact on their food costs.
Well, we definitely can help you there if you're not getting our reports, particularly the Maloney report. And we do provide forecasts and information around that, and you can certainly reach out to us or Kate along that, or you can also obviously keep track of the USDA and the information they're providing.
Okay, great. And then one other question from earlier, someone was wanting to know if our commodity data is integrated with the sourcing tool mentioned earlier in the presentation. And I will say short answer is yes. And I'll let David kind of talk about more of the details on that integration. Yeah,
it's the integration is started and is only going to get better in the coming months. Our clients will have access to forecasts and charts, historical data, all around the sourcing platform and the general ArrowStream platform, as well as our reports. So very exciting with the integration.
Thanks, David. We have a couple more that are coming in. A participant would like to know, has South America planted more this year to make up for the shortfall here in the U.S.? And how does that price look to U.S. protein suppliers?
Yeah, good question. So they haven't planted yet. They'll plant in the coming months, right? For the 1920 crop, which will be harvested, start to be harvested in the Feb period, okay, of 2020. But higher prices are only going to encourage planting and production down there. So assuming the weather is at least normal, we expect big supplies to come out of South America. And that's one of the things I was speaking to earlier about the demand issue is we already are struggling to export corn at this level. Ethanol producers in the United States are struggling, which I'm sure is just horrible news for everybody on this call. I'm being sarcastic, obviously. So we fully expect South America to have big crops, at least this year. And if we do have a big loss in the crops here in the United States, and the markets go, if corn goes up near $5 and is able to sustain there, and we don't expect that to happen, but I'm just saying if it does, we would expect plantings and crops to be that much bigger down in South America. So this is not an ethanol issue, right? Where we have a big demand pool, a growing demand pool on our supplies, folks. This is likely a short-term interruption, okay? A relatively short-term interruption.
Thanks, David. And we have one more. Someone just wants to confirm, I know we'd mentioned, or bullish on soybeans, but they wanted to confirm that this was the case even with the reduced Chinese demand.
Sure. So I think one of the things that was interesting, okay, with for those of you who get our information know, probably the biggest message that we conveyed coming out of that June acreage report from the USDA was all of a sudden the soybean crop was vulnerable with that lower acreage. And that was unthinkable going into that report because one, soybean supplies in the United States right now are huge. They're burdensome, right? And two, there was a lot of expectations that some corn acres would shift into soybeans. So we might even see a higher soybean acres number in June than we got in March, but we got the opposite. So, our models, our standard models, right, based on our supply demand on soybeans, okay, on the ending stocks for use ratio, suggests soybeans should be about 940, 930, 950 a bushel, right? We're not anywhere close to that right now. China remains a wild card, and that's probably gonna keep a lid on corn prices some, or temper the upside, assuming we don't get a deal there. But I do think there is a risk in soybean prices to the upside, okay, depending on how these crops play out, which I wouldn't have said before the June 30th acreage report.
Okay. Well, that looks like that's all the questions. So thank you, everyone, for those questions. Before we wrap up, I want to briefly mention that we will be sending out the recording of today's webinar to everyone later on today. Also in that email, for those who are interested in learning more about our strategic sourcing and commodity intelligence tools, there will be a link to a form for you to fill out, and you can let us know that you're interested. So thank you again to our presenters and for everyone who dialed in. We look forward to having you on our next webinar, and have a great rest of your day. Thank you.